You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. Happy days are here again. The CPI only rose at 8.5%. Gas prices are going down and things are just peachy. And I guess if you're an investor, it's safe to go outside now. Well, let's find out from Matthew Johnson, Johnson Wealth and Income Management, that is. Matthew, you're third generation at this. So when we add up your collective wisdom, I guess you're probably your dad and your grandfather, you've between, at least they did, you're a little younger, but they pretty much saw everything in this business. It's 75 years. I mean, that's going back to the 40s, World War II, the aftermath, Korea, the Cuban Missile Crisis, you name it. But more importantly, during the 60s and 70s, they were in an inflationary period, and they didn't just go away. This inflation lasted for a couple of decades. Why is this inflation different than the last?
Well, it's really interesting that you say that. Funny story, when I was quite a bit younger, my dad, being the prudent business owner that he was, believed in child labor. And I remember being a little boy, and I would file statements for annuities and life insurance policies and this sort of thing. And of course, I didn't know what any of those instruments were, but I remember looking down and seeing 13% and 14% interest in those things. And so it piqued my curiosity, and I started asking my dad, what is interest? And he starts explaining it to me. Things have vastly changed, haven't they, with regards to the economics in this country. And yet what we see is that maybe this inflation that they tried selling us on the idea that it was transitory, maybe it's not as transitory as what we believe.
Really?
One of the biggest misconceptions, I think, that people have about this inflationary environment that we're living in is the fact that, well, the feds are going to be able to fight this inflation by taking and driving down demand. But the reality is that it's not the demand that's the problem. The problem is through the supply chain issues that we're having in this country. And because we've had so little investment in the infrastructure of supply chain within the economics of this country, because things were rosy, things are going along just fine. When you shut down the economy, all of a sudden, it's going to reveal all sorts of problems. And, the Federal Reserve is indeed responsible. The government is responsible for much of what we're seeing today, not only because of the shutdown in the economy back in 2020, but every time you make an abundance of cash available in our economy, every time you lower interest rates and you make money cheap to borrow, and then you make that process last a little too long, and all of a sudden you let people out of their house and you say, okay, back to normal. Guess what? You're going to have pent-up demand. You're going to have a very fractured supply chain environment, and you're going to still have the tailwinds of that cheap money and people wanting to spend that money. Today, we're seeing an epidemic across this country where more and more families are running lower and lower on income and money. Things are costing more, and so they're opening up tremendous numbers of credit cards. Why are they doing that? They're doing it because the inflation is a very real thing. And yes, gas prices are down a little bit, but grocery prices aren't. Medicine's not. There's all sorts of things that are still affecting the households of Americans. And it's something that's going to be with us for quite some time.
All right. So you make a great point. I remember when interest rates were in double digits and practically threw the United States and the entire global economy into a major depression. When you talk about infrastructure and how badly underinvested it's been in some areas, where I am in Florida, perhaps not so much, but it's a global issue. When you ask somebody how much is a kilowatt of electricity, what did it cost? They'll tell you somewhere 14 cents, 19, depending where in the country you are. The real answer is $5 trillion because that's all the infrastructure that takes that electricity from its source to your outlets, to your light bulbs, to your uh, EV. And what the government's like not realizing is, hey, transitions are great. They're disruptive for sure. Hopefully there's a better outcome on the other side of that transition. But you can't just flick a switch like you do to turn your lights on and say, transition appear. This needs a lot of planning, a lot of investment, and patience. So, when you see this kind of thing, and then you have a shutdown like we had to really bring it home, you see that we're in for some hard times here.
Absolutely. And you make a good point because it's almost as if we understand what the agenda is. Before Biden became president, he made a vow to Americans that he was going to reduce the dependence on oil and petrochemical companies and fossil fuels in general. And so in their quest to try to promote electric vehicles and things of that nature, which I have no problem with, if that's what floats your boat, fine. But the reality is that you can't choke the normal processes and the streams of energy production at the same time that you're trying to further your agenda to incentivize people to go to electronic vehicles. Right now, if we go back in time to 2020, no one was there. The government never stepped in to save the petrochemical companies. They were losing money by the billions of dollars every single month. And today, the petrochemical companies that are producing the oil and producing the gasoline and the diesel and all the other forms of energy that we consume as Americans, well, now they've become the whipping boy. The finger is being pointed at them saying, listen, you're the bad guy. And yet, if we think about the big picture, for instance, under the Trump administration, there was, and I could be wrong on my numbers, but it was around 500 million acres that were being basically allowed to be tapped for oil production because our goal was to get away from other foreign oil. It was to become as independent as possible. And since that time, we've virtually eliminated all of that. We've got very little drilling access in this country. And so they love to point fingers. They love to be able to say, this is the agenda and isn't this wonderful? And of course, we just have this inflation bill that just gets passed yesterday on the 16th that basically says we're going to, create greater, more efficiency for our country. We're going to create more incentives to go to electric vehicles. Wonderful. But at the same time, if you're choking the other petrochemical companies, the other oil producers that we're still very heavily reliant upon for our diesel to move our trucks and our cars to move the gas to move our cars, this is a tax not on just some people. This is a tax on everyone. And we need to be addressing more than just gasoline. There's so many more other areas that are important to the American family.
So true. So true. Not that the times were perfect under Trump. Debt kept going up and up and up. And don't forget all these stimmies that really increased the money supply and are driving the inflation. Many of those programs were implemented by the past occupant of the White House. So we don't, it's not a political issue here. It's purely economic. So you got tons of clients who've come to rely upon you and your family for the past 75 years. What are you telling them? Put your money in a passbook or buy CDs or treasuries or go buy roulette futures. What's the deal?
Well, the number one thing that we all need more of, Kerry, when we are living in an inflationary environment is more income. And that's my specialty. That's what I like to do for clients. I'm very specialized in my field. As a fiduciary, my responsibility is to help a person take what they work so hard to save and turn it into income. So I think that there's a few things that we need to be mindful of. The first is, I remember when pot was being legalized, and I would have clients that would call and they would say, "Hey, should we get into pot? That's going to be a good thing. Everybody smokes pot, right?"
Yeah.
Well, then all of a sudden, that dies away. And we've got clients that are calling saying, should I get into gold? Should I get into gold? Should I get into cryptocurrency? Right? They're not stupid. They're watching the news and they're thinking about, what are they going to do to be able to diversify? The key is not to put all your eggs in one basket. So is there something that we can do to diversify at the same time further our objective of having more income? And I believe that there is. So the first thing that we need to do is we really need to analyze how we're investing our money, and we need to be truly diversified. Diversification is not having 14 different mutual funds. Diversification is having, as you would put it, some safe money. Maybe that's going to be in cash. Maybe that's going to be in CDs. Maybe that's going to be passbook. Maybe that's going to be some short-term treasuries. That just is just wise. It's something that's going to be easily accessible, and it's going to be cash, and it's going to be safe. But we don't want too much money there because we're going to be losing too quickly to inflation. And that's like financial pneumonia.
Sure.
So we need to be looking at other instruments. So is there things in the fixed income world that we could be investing in? Well, interestingly enough, this is a repeat of 2018. We all remember what happened in 18 because of all the stimulus during the Great Recession. We saw that they drove interest rates down to zero. They opened up money supply to stimulate us to spend. And what that did was that created a lot of spending, but the economic car towards 2017 is now careening down the road. It's going too fast. They're headed towards the cliff again. And so in 18, they started raising interest rates to help to cool the inflation. Well, the same thing is happening today. And what happens is when you have individual fixed income contracts, whether that's individual corporate bonds, whether that's preferred stocks, business development companies, that sort of thing, those things begin to contract in price. And because they're contractually producing interest and dividends, this is something that I think should be a part of just about everyone's portfolio. If you can be making 5-6% in interest and dividends on that portion of your portfolio, now you've got something that's truly producing income you can spend without touching the principal. Additionally, I think that there is a necessity to take a look at equities, but not just any equities. Most equities today may produce some degree of dividend, but it's going to be very paltry. You're talking maybe 1.2% on average, maybe 1.5 if you get lucky. But if we go back to the main concern right now, which is recession, we want to be looking for stock companies that are free cash flowing. We want to be looking for companies that are very mature in their life cycle, and companies that have a history of paying dividends over the course of the last 30, 40, 50 years, because over the course of time, they've increased those dividends. And this allows a person not only to be able to buy these equities at a much discounted price because of all the volatility that's taken place in the market, but you know what? That dividend helps you to multiply your returns. Because if some of those companies are down, and we're talking Dow, we're talking AT&T, we're talking Johnson & Johnson and Pfizer, when these companies are down, well, they're down with the rest of the market. We can buy them. We know that if the recession really does occur, it's unlikely that they're going to go out of business. So they'll be more recession resistant. But as they come back, as the market does improve, and the market will likely improve given a long enough period of time, they're going to be magnifying and multiplying their returns because they're going to be getting paid that 3.5%, 4.5% dividend on top of it. If you're truly concerned about, inflation and you want a little bit of gold, fine. We look at gold over the course of the last year. It's relatively flat. It had a peak earlier in the year, but it's relatively flat for the year. But is it a good diversification for a portion of your money? Of course it is. But I always encourage clients to have it in coinage form. This way they've got the value of the metal itself, but they also have the antiquity value that coin can bring.
Right. So these are almost like Warren Buffett kind of stocks. They're defensive stocks. Mm-hmm. So you're kind of pointing to the Dow Jones more than to the NASDAQ or the FANGs, mm-hmm. although some of these FANGs could be in the position like an Apple of just generating way too much cash. They could become a dividend aristocrat mm-hmm. In the future. So we look for high dividend yielding stocks that have a history over how many years? 25 years, 15 years. There's some that are aristocrats. They've been doing it 50, 75 years. There's others that have been doing it for less time. You would call them maybe dividend nobles. So what should you look to? Because you want to find that sweet spot, right? Where the market hasn't yet perceived them as an aristocrat. So they're yielding more, right? So just give us an example.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, I think that there's a couple of criteria. First and foremost, we definitely want to pick a company that has paid dividends faithfully over the course of the last 2 decades. I think that that's important because when we consider, what happened to the stock market and the economy in general during the dot-com bubble, where the S&P is down 50% in the first 3 years at the turn of the century, and then we see, the Great Recession of 2007, 8, and 9. If there's companies in there that we're analyzing, that we're looking at, that have paid dividends faithfully without cutting them, without suspending them, without drastically reducing them during the last 2 decades, I think that that's a really good litmus test. We also want to be very, very careful to look at the economics of the country. As I said before, we want free cash flowing companies. Just a week and a half ago, 2 weeks ago, I was being interviewed and we were talking about big box retailers. And I'm very cautious on those because right now they're just completely choking on inventory. And what was it yesterday? Target comes out and they basically say that exact same thing. We've got too much inventory. We're having to slash prices on everything just to move the inventory because people aren't spending money. We want companies that are not going to be affected as much by those little blips. Correct.
Okay. So, hey, are these financial stocks? Financial stocks, looks like every 10 years they're getting bailed out, right?
Well, you could say that some financial sectors are going to be good. When we look at insurance companies today, insurance companies, for the most part, are seeing higher and higher yields in their bond portfolios. They're doing pretty well. Although we have to be very analytical and look at the fundamentals of the actual insurance company, because there's a lot of insurance companies that have divested towards growth. They got sucked into the optimism of the market and they started to really kind of maybe sway a little bit on their convictions. So we want companies that have very strong balance sheets, companies that are very conservative. They're not investing in, speculative real estate to try to make their quotas on interest returns to their policyholders. We want to most definitely stay away from companies that have a large exposure to foreign countries. When we look at what's going on in China right now, if you're looking at a financial company and they have a large exposure to China, that could be a major problem for that company. So financials could be part of it. It was interesting. I remember back in 2015, I believe it was, and it was Jamie Dimon, and he made a comment. He said to his shareholders, remember that we are going to reach a point in which we will have inflation, we will have a recession. They're going to have to start raising interest rates. That was back in 2015. And boy, did he call it right, because he saw what was happening. He saw all the infusions of money and the bailouts and things that had happened during the Great Recession. And he was letting his shareholders know, we have to be very careful to diversify, very careful of what we're investing in. Things are improving incrementally, and I hope that they continue to improve. But we have we've got a lot of runway left before we can say that we're out of the woods on this. We have to be very, very studious.
Okay. All right. Well, so uh, your clients, what's the average age of your clients?
Well, I guess I'm very unique in the fact that I only work with people that are 55 and over. And as I said, I've made it my quest to be different and be very specialized in the sense that I help people take what they've worked so hard to save and do two things with it. Number one, make it safer. And number two, get that working capital to produce income for them. The number one fear that I see coming from clients today is not the fear of dying, it's the fear of running out of money. And when I'm working with clients, I would say the average client is probably around 62 years of age. Obviously, some a little bit younger, some a little bit older. We can't just look at portfolios. We have to look at everything. We have to look at, if we have a pension, if we're lucky enough to have one, what's the best pension election? If we have Social Security and we're married, we have a spouse, what do we do to maximize that Social Security? What's the single best strategy? What's the second best strategy? We need to optimize how we take our Social Security. And we need to take those two things and we need to think of it in the context of what we've saved for retirement, what we've got in our 403Bs and our 401Ks and our IRAs. And if we have working capital that's sitting in the bank, we've got too much sitting in the bank and the bank is borrowing that money out, lending it for 6%, 6.5%, and yet they're paying us 0.025%. Well, that's working capital. It's not working. And people need to realize that where so often we can kind of get relegated mentally to the bookends of the investment world, where we think of the safe money and being in the bank, and then we think of the risky money being in the stock market. There's an entire universe, Kerry, of things that exist in the middle that are safer than the stock market, that are producing much, much greater streams of income through interest and dividends. And here's the best part. They're down right now. They're down. We can buy these things at a discount. And when we're dealing with this inflation and we're actually seeing our portfolio producing, 5%, 5.5%, 6% in interest and dividends, that's real, that's tangible. We can spend that. And we don't have to worry about selling shares in a down market. We can be that proverbial buy and hold investor.
All right. I like it. Hey, one final question, and just want to get your take on it. Real estate. What do you think, Matthew? Obviously, real estate's fragmented, hundreds of markets across the country. What's happening in Detroit is not what's happening in Miami. What's happening in New York isn't what's happening in Dallas. But real estate, over time, it's got tax advantages. It's got basically you take on debt and you have somebody else pay it for you. Mm-hmm. And it's got equity, silent equity buildup, all these things. You pro real estate in this current environment?
Well, I'm very pro real estate cautiously. Let's put it that way. Depending upon the real estate that you're discussing. So I'm in Iowa, right? I'm in the heartland of America. I am surrounded by farm ground. And I remember back in 2005, I bought some farm ground and I paid $4,500 an acre for that. Today, that farm ground is worth all of $15,000 to $18,000 an acre. It's insane what real estate has done within the hard, tangible, tillable ground. Then we have other areas. We've got duplexes, we've got apartments, we've got single family homes, we've got things of that nature. Real estate has certainly seen a tremendous boost. And when we look at this inflation in the CPI, we know that it makes up roughly about a third of that CPI. And we know that part of the factor of the inflation of the CPI is the fact that real estate has been growing and it's been compounding, and it's going to, it's now in a position where it's softening. I believe in owning real estate that is income producing. Like you said, if we're going to put working capital into something, it's got to have the ability of having some silent appreciation. It's got to have the ability of us being able to produce a revenue off from it. And so, yes, I believe it is a wonderful diversification for a portion of a person's money. Many people, as they age, however, they don't want to be owning all those rentals. Farm ground's pretty simple. That's just a lease agreement, but the upkeep of rentals and that sort of thing. And this is where people can transition away from those rental producing properties into things that are more contractual and fixed income, whether it's bonds or preferreds or things of that nature, and they don't have to deal with the tenant. But yes, I'm very much pro real estate. We just have to be wise about how much we're spending to buy that piece of real estate, and doing the math to make certain that it's not a fool's errand and that it's going to take us, 50 years to make our money back.
Okay. Hey, one final question. ETFs versus mutual funds, because obviously you got an over 55 crowd and they're thinking about estate planning. And ETFs, you get stepped up basis. Mutual funds, you don't. Mutual funds, you pay taxes on phantom gains. You put your clients into ETFs ahead of mutual funds?
Absolutely, every single time. Mutual funds are one of those things where they were useful. They were kind of the new kid on the block. We've used them for years and years and years and years. But we found that the ETF, it has so many more advantages over the mutual funds. I find that they're so much less expensive, and we have to take expenses into context of our portfolio, because the less we pay in expenses, Kerry, the more money we get to make, the more money we get to keep in our pocket. And so I believe that ETFs are the single best winner if the discussion is ETF versus mutual fund, every single time.
Okay. And it appears that the forces that be, the powers that be in their finite wisdom in DC have just left this kind of as a giveaway or tax mitigation strategy for people who are older in their years. Hey, well, I think we've covered a pretty wide swath. If you're amenable, Matthew, I'd love to have you back on next month or so. Let's take a look, see what the markets have done, and then we can kind of go through different asset classes, see how they're performing, and you share with us what your recommendations to your clients are. That would be good for you.
Yeah, sounds great. Thank you so much for having me on today, Kerry.
A complete pleasure. The website is johnsonwim.com, and there's a link to it in the show notes. This interview on financialsurvivalnetwork.com. While you're at it, why don't you subscribe to the site? Also, I'd like to know how you're handling your portfolio, what you're doing to overcome the effects of inflation and the economic uncertainty that surrounds us. Are you in cash? Are you in metals? Are you going into those dividend stocks? Are you fully invested in real estate? Just share with us that, and perhaps we'll have you on the show. We'll talk about it. At the very least, we'll read some of your feedback. And Matthew, I want to thank you for coming on. Really appreciate it. Oh, the email address again is kl@kerrylutz.com. If you got a question for Matthew, shoot us an email. We'll get you an answer quickly. Matthew, we'll talk to you again soon. Thank you so much for coming on.
Thank you so much.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.